Most people invest based on headlines, hype, or hope. Smart investors invest based on numbers. And today, I'll show you exactly which numbers matter. It's easy to get caught up in news about the next big stock, but that's not investing, that's gambling. The real secret to building long-term wealth isn't about having a crystal ball, it's about having a calculator and knowing what to do with it. Successful investors focus on analysis over speculation, making informed decisions based on data, not gut feelings. Think about it. You wouldn't buy a house without inspecting it. So why buy a stock without checking its financial health? Today, you'll learn the 5 essential financial ratios that professionals use to spot strong, durable companies. We'll break down each one step by step so you can confidently analyze any company's financials. Grab a notepad. Let's get started. Let's start with the most famous ratio, the price to earnings, or PE ratio. The PE ratio tells you how much you're paying for each dollar of a company's earnings, a price tag for profits. The formula is simple: share price divided by earnings per share. Most financial sites calculate it for you, but it's crucial to know what it means. The PE ratio shows the relationship between a stock's price and the company's actual profit. But a PE ratio alone is meaningless. You need context. Compare it to the industry average. A tech company's PE might be 40, while a utilities is 15. Neither is good or bad on its own. Also, compare a company's current PE to its historical average. Is it trading at a premium or discount? A high PE can mean optimism about future growth, or it could signal overvaluation and hype. A low PE might look like a bargain, but it could also mean the company has serious problems. The market usually has a reason for low prices. Your job is to find out why. Remember, a low PE doesn't always mean a stock is cheap, and a high PE doesn't always mean it's expensive. A low PE means there are questions the market is asking. Your job is to investigate: is the market's doubt justified, or is it an overreaction you can profit from? Don't just buy what looks cheap, dig deeper. The PE ratio is your first filter, not your final answer. Use it to spot opportunities, but always look for the story behind the number. Smart investors use the PE as a starting point for deeper research. It's about understanding value, not just chasing low numbers. That's how you avoid overpaying and how you find real bargains. Let's move to the next ratio. Next is return on equity, or ROE, a direct scorecard for management. ROE measures how efficiently a company turns shareholder money into profits. The formula: net income divided by shareholders' equity. A consistently high ROE, say above 15%, signals strong management and a competitive advantage. Compare ROE to industry peers. If one company's ROE is much higher, it likely has a superior business model. But beware, companies can inflate ROE by taking on too much debt, shrinking equity, and making returns look better than they are. Always check if high ROE is backed by reasonable debt levels. A high, stable ROE with low debt means management is creating real value. A low or volatile ROE, or one boosted by debt, suggests weak leadership or risky strategies. Use ROE alongside other metrics, especially those measuring debt. ROE is a clue, not the whole story. Dig deeper to see if high returns come from operational excellence or financial engineering. That's how you judge management quality. Now let's talk about the debt to equity ratio. The market's risk gauge. This ratio shows how much a company relies on debt versus shareholder investment. Formula: total debt divided by shareholders' equity. A lower ratio means a company is more stable and less vulnerable to downturns. A higher ratio means more risk. Debt can boost returns in good times, but can be dangerous if things go south. Context matters. Capital-intensive industries, like utilities, often have higher debt-to-equity ratios than tech companies. Always compare to industry averages. Debt is a double-edged sword. It can accelerate growth or magnify losses. If a company's revenue drops, high debt can quickly become a crisis. Profitable companies can go bankrupt if they can't service their debt. When you see a high debt-to-equity ratio, ask, is this smart growth or reckless risk? Use this ratio to spot companies that are over-leveraged. Look for businesses with manageable debt and strong cash flow. The debt-to-equity ratio helps you avoid companies that are one bad quarter away from disaster. It's essential for managing risk in your portfolio. Next is the current ratio, a quick test of a company's short-term financial health. Formula: current assets divided by current liabilities. This tells you if a company can pay its bills over the next year. A ratio below 1.0 is a red flag. More bills due than cash on hand. A healthy range is usually 1.5 to 2.0, meaning the company has a comfortable cushion. Too high a ratio, like 4.0 or 5.0, can mean inefficient use of assets. Too much cash or inventory sitting idle. Profitability doesn't matter if a company can't pay its bills. The current ratio cuts through accounting tricks and shows real liquidity. Before investing, make sure the company can survive the next 12 months. This ratio is your margin of safety. It protects you from companies that look good on paper, but are actually in trouble. Use it to avoid businesses standing on a financial cliff. Liquidity is survival. Never ignore it. Finally, my favorite ratio, free cash flow margin. This measures how much real spendable cash a company generates from its revenue. Formula: free cash flow divided by revenue. A 10% margin means the company keeps $10 in cash for every $100 in sales after all expenses and investments. Free cash flow is the lifeblood of a business. It funds dividends, buybacks, debt repayment, and growth. Strong growing free cash flow gives a company flexibility and resilience. Watch for companies with rising profits, but weak or negative free cash flow. That's a red flag for accounting tricks. The cash flow statement doesn't lie. Remember, earnings are an opinion, cash is a fact. Free cash flow shows the true economic reality of a business. High free cash flow margin means a high quality, durable company. These are the businesses that build real wealth for investors. Focus on cash, not just reported profits. Over time, companies that gush cash outperform. It's the ultimate sign of strength. There you have it. 5 powerful ratios to transform how you analyze stocks. We covered PE, ROE, debt to equity, current ratio, and free cash flow margin. Successful investing is about reading the present clearly, not predicting the future. These ratios help you cut through hype and see the real story. Build your process on logic and evidence, not emotion. If you found this helpful, hit like and subscribe or follow for more investing frameworks. Comment below. Which ratio do you use most? Or is there another you love? Thanks for watching. See you in the next video, where we'll apply these ratios to a real company in real time.